All units, attention. Shut down that portfolio screen. Kill the Bloomberg feed. Whatever ticker you're watching, whatever analysis you're running, whatever position you've been nursing since Monday morning, freeze it right now. Because 17 minutes ago, a sequence of numbers published on a government monitored exchange just proved something that banks have spent 40 years denying. Numbers that break the fundamental laws of market mathematics. Numbers that confirm what conspiracy theorists have been screaming about since 1980. Turn off the experts. Silence the talking heads. What's happening right now isn't prediction. It isn't forecast. It's documentation of a collapse already in motion, and I'm watching institutional money managers realize it in real time. Today is January 15th, 2026, and at 2:07 p.m. Eastern, the lie died. Let me walk you backwards through what just detonated, because understanding this determines whether you still have wealth in 30 days or whether you're about to watch it vaporize while you were busy scrolling news feeds. There's a foundational rule in every legitimate market since the invention of commerce. You cannot sell what you do not possess. If you walk into a store and buy milk, that store must have milk in the refrigerator. If you purchase a car, the dealer must have a title proving ownership. This isn't advanced economics. This is second-grade logic. Except commodity futures exchanges discovered a loophole 60 years ago. They realized most traders never wanted the actual commodity. Most traders wanted exposure to price movement, buy a contract, ride the wave up or down, sell the contract, pocket the difference, never touch physical anything. So the exchanges got creative. They started issuing more contracts than commodities existed to fulfill them. 5 contracts per actual bar of metal, then 10 contracts, then 20. Nobody cared because nobody was actually demanding delivery. Everyone was playing hot potato with paper. The COMEX, Chicago Mercantile Exchange, became the master of this game with silver. For decades, they issued silver contracts at a 15-to-1 ratio. 15 people holding pieces of paper claiming ownership of the same ounce sitting in a New York vault. And it worked beautifully because those 15 people never showed up at the same time asking for their metal. Until 17 minutes ago. Let me explain what First Notice Day actually means in language that cuts through the financial jargon, because this is where fantasy collides with physics. First Notice Day is Judgment Day for futures contracts. It's the moment traders must declare their intentions. You either accept cash settlement, meaning you take dollars and walk away, or you demand physical delivery, meaning you want the actual metal delivered to you. Every February for the past decade, roughly 9,000 contracts have stood for delivery. That's 45 million ounces of silver. Historical pattern. Predictable. Boring. The COMEX warehouses would typically hold 100 million ounces in registered inventory ready for delivery. Simple arithmetic. Demand 45 million, supply 100 million. The machine functioned without drama. Today at 2:07 p.m., the CME published February 2026 delivery intentions. 47,012 contracts stood for delivery. Hold that number in your mind. Don't scroll past it yet. 47,012 contracts. Each contract represents 5,000 ounces. Basic multiplication. That's 235,060,000 ounces of physical silver being claimed for delivery within the next 28 days. Now here's where mathematics becomes impossible. COMEX registered inventory, the physical metal officially designated as available for immediate delivery, currently sits at 23.1 million ounces. Read that again slower. 235 million ounces claimed. 23 million ounces exist. 10 people holding contracts saying, "This silver belongs to me." 1 ounce of actual metal sitting in the vault. 9 of those contracts are backed by empty air and institutional confidence. This isn't a supply squeeze. This isn't market tightness. This is mathematical fraud proven in real time with exchange published data. And the most chilling part, every major bank saw this exact data at 2:07 p.m. today. Every commodity desk, every trading algorithm, every institutional risk manager. They're all staring at the same numbers right now. They all understand what those numbers mean, and they're all frozen trying to figure out which lie to tell first. The system just admitted it cannot fulfill its promises. The contracts are counterfeit. Walk back with me 14 days to understand how this trap was constructed, because today wasn't the beginning. Today was just the moment the walls closed, January 1st, silver trading at $85 per ounce. The COMEX getting nervous. Delivery requests climbing, so they deployed their standard weapon. Margin requirement increases. Margin is the collateral you post to hold leveraged positions. If you're controlling contracts with borrowed money and the exchange jacks up margin requirements 15%, you either inject more capital or liquidate your position. The COMEX raised margins hoping to flush out speculators, trigger panic selling, crash the price. For 2 days, the strategy worked. Price slid from $88 down to $85. Weak hands got margin calls, some folded. Then the unexpected happened. Different buyers emerged, not retail speculators trading on margin, not hedge funds playing momentum, industrial manufacturers who need physical silver for electronics production, sovereign wealth managers allocating hard assets, entities with deep capital who don't use leverage. They don't care about margin requirements because they're paying cash. They need the metal. Price reversed from $85 back up to $91. And instead of delivery demand cooling off, it exploded to 47,012 contracts, the highest delivery demand in COMEX history for any February contract ever recorded. The manipulation backfired, and now the exchange has no bullets left in the chamber. Let me show you why every traditional escape mechanism is welded shut. In functional markets, when you hit this kind of supply-demand mismatch, arbitrage should resolve it. Smart traders should buy silver from surplus locations, transport it to deficit locations, profit from the price gap. Market forces self-correct. But arbitrage is dead. Shanghai is currently pricing silver at $104 per ounce. When Shanghai trades above New York, that signals Shanghai is short supply too. Chinese manufacturers competing for limited material. And on January 1st, China implemented export controls. Silver entering China cannot exit without government licensing. China is issuing 0 licenses. Asia's supply is locked. What about London, Dubai? Fresh mining output. Physical silver transportation requires 4 to 6 weeks minimum. You need logistics coordination, customs clearance, COMEX certification for delivery eligibility. February delivery begins in 10 days and closes in 28 days. The deadline arrives before the shipping window completes. There's no time left. And the bullion banks, JP Morgan, HSBC, Scotia Makata, they're the ones trapped on the wrong side. They're the entities who sold those 47,012 contracts without holding the physical metal to back them. Delivering now means purchasing silver at $91 to cover shorts they wrote at $60. That's $31 per ounce losses, multiplied across 235 million ounces. They're paralyzed hoping price drops so they can cover cheaper. But price is climbing, and hope isn't a trading strategy, it's desperation. So the arbitrage mechanism that should rescue broken markets is completely disabled. Metal cannot be sourced. Timeline is too compressed. Banks are checkmate. Let me translate this into ground-level reality, because numbers on exchange screens don't capture the human panic unfolding across continents right now. India, silver just breached 300,000 rupees per kilogram. That converts to $136 per ounce. COMEX says $91. India says $136, $45 premium over paper price. But here's the critical insight. At $136, the metal is completely unavailable. Major dealers in Mumbai, Delhi, Bangalore showing out of stock on digital platforms. Phone calls get responses like, possibly next month, cannot confirm. This transcends pricing. This is availability collapse. Indian buyers would pay $150, $170, $200 if metal existed for purchase. It doesn't exist. United States retail market. Silver Eagles trading at $142 per ounce with spotty inventory. U.S. Mint suspended sales. Dealers quoting 6 to 8 week delays. Shanghai premium over COMEX, $13 per ounce and widening hourly. These are actual transaction prices. These are what humans pay when they need tangible metal in their possession, and none of them approach $91. So which price represents reality? The paper number flickering on COMEX screens, or the physical price people actually pay in Mumbai, Shanghai, and Dallas? Physical is truth. Paper is theater. Today's delivery data just ripped the curtain down. Now understand the binary choice confronting these banks, because both paths lead off a cliff. Path 1. Locate 235 million ounces of silver and deliver it. The COMEX holds 23 million registered. They're short 212 million ounces. Where does that quantity materialize from? Mining companies have pre-sold most 2026 production. Refineries quoting 8-week lead times minimum. Private holders refusing to sell because they recognize scarcity is accelerating and prices are ascending. The physical metal doesn't exist in deliverable form within the required time frame. It's geometry. You cannot fit 10 gallons into a 1-gallon container. Path 2. Declare force majeure. Force majeure is the legal escape hatch where an exchange announces that delivery is impossible due to extraordinary circumstances beyond their control. All contracts get cash settled at an exchange-determined price. Longs receive dollars instead of metal. But declaring force majeure is an admission. It's confirmation that COMEX contracts aren't backed by actual silver. It annihilates confidence permanently. The instant force majeure is announced, physical markets detonate. Shanghai gaps to $130, India gaps to $160, US retail becomes unavailable at any quoted price, and COMEX paper price collapses because everyone realizes COMEX silver is merely a cash-settled derivative with zero connection to tangible metal. The spread between physical and paper could blow out to $50, $70, $90 per ounce. We would have two separate universes, physical and paper, and if you're holding paper, you chose the wrong universe. So banks are trapped between two impossible choices: deliver metal they don't possess, or admit the paper market is fabricated. Either way, this is terminal. Either way, the game ends. Now connect this to the larger structure fracturing beneath us because silver isn't isolated. This is systemic unraveling. Gold just printed new all-time high, $2,644 per ounce. When gold goes vertical like this, it's a confidence vote against fiat currency and central bank credibility. U.S. Treasury yield spiking. 10-year just hit 4.71%. That means bond prices falling, investors dumping U.S. government debt. S&P 500 down 14% from November peak. Technology stocks getting demolished because companies requiring commodities face exploding input costs and margin compression. Tesla announced production halt due to silver shortages. Apple delayed iPhone 18 launch citing component unavailability. These aren't isolated headlines. These are symptoms of commodity crisis metastasizing into real economy, and the Federal Reserve is trapped. Cannot raise rates to defend the dollar without imploding the economy. Cannot lower rates to stimulate growth without igniting inflation. No good moves remain on the board. The system is in zugzwang. Every move accelerates destruction. And 47,012 contracts standing for delivery is just one visible fracture in a failing architecture. Here's your timeline for what unfolds next, because everyone wants to know when breaking point arrives. Next 7 days, COMEX scrambles frantically. They'll beg holders of eligible inventory to reclassify as registered. They'll offer premiums, incentives, favors. Maybe they scrape together another 10 or 15 million ounces. That brings registered inventory from 23 million to perhaps 38 million. But they still need 235 million, still catastrophically insufficient. Around January 22nd, 1 week from today, COMEX issues carefully crafted statement. Language like, given extraordinary physical delivery demand and persistent supply constraints, CME Group is evaluating all available options to ensure orderly contract settlement. That's coded language. That's the warning signal. Markets panic. Silver gaps overnight. Shanghai jumps to $120. Then approximately January 30th, 10 days before February delivery window closes, the official announcement drops. Force majeure declared. Alternative settlement procedures implemented. All contracts cash settled at predetermined formula price. Physical delivery suspended indefinitely. That's when paper market dies permanently. When that announcement hits, physical silver becomes unobtainable. Shanghai at $140, India at $170, US retail completely depleted. Meanwhile, COMEX paper price craters to $70 or $60 because market participants realize it's not real silver. It's just a cash-settled derivative disconnected from physical reality. The bifurcation becomes permanent. Two markets, physical and paper, and they never touch again. Understand what today's number actually represents. 47,012 contracts is 47% of open interest. Historical norm, 5 to 10% stand for delivery. Today was 9 times normal behavior. This is a bank run. You understand bank runs. Bank keeps 10% reserves, loans out 90%. Normally 5% of depositors withdraw simultaneously. System functions smoothly. But if 20% show up demanding their deposits at once, bank cannot pay. Vault is empty. That's bank run. Today, 47% of COMEX contract holders showed up demanding their silver. COMEX only holds reserves for 10%. Bank runs don't reverse, they accelerate. Next month, 55% stand for delivery, then 65%, then 80%, until exchange shuts physical delivery entirely. This isn't temporary squeeze, this is structural collapse. COMEX sold more ownership claims than silver exists. They operated fractional reserve commodity market. And today depositors showed up. The vault is empty, the lie is exposed. So here's what this means for you personally right now in concrete terms. If you own physical silver, bars, coins, allocated storage in your name, do not sell. You hold the winning position. COMEX just proved they cannot deliver. Physical and paper are diverging permanently. Paper price might stay suppressed or dip, but physical price is heading to $120, $150, $180 as availability evaporates completely. You own the real asset, not promises, not contracts, not digital entries, actual metal. Guard it like your life depends on it. If you own silver ETFs like SLV, you are in danger. SLV is custodied by JP Morgan, one of the largest shorts in this market. Do you trust that JP Morgan actually possesses all the silver SLV claims to hold? Or do you think perhaps they've hypothecated it, lent it out, pledged it to multiple counterparties? Today's data proves 10-to-1 ratio of claims to metal. You think SLV is different? You think they're special. When redemption requests flood in and physical metal isn't there, you get cash settlement. You receive $91 per ounce while physical trades at $160. That's $69 per ounce loss because you trusted paper over metal. Exit SLV, convert to cash, buy physical. Execute this week. If you're holding COMEX futures planning to stand for delivery, you probably won't receive your silver. COMEX is short 212 million ounces. They cannot deliver. They will invoke force majeure and cash settle your contract. You wanted 5,000 ounces at $91. They'll mail you a check for $455,000. But on settlement day, physical silver is trading at $120. Your metal should have been worth $600,000. They just legally confiscated $145,000 from you. And it's completely legal. It's buried in contract fine print nobody reads. If you don't own any silver and you're considering buying, the question isn't should you. The question is, can you still locate any? Because 42,000 COMEX contracts that won't get delivered are about to flood retail markets searching for physical metal. Every disappointed long is calling APMEX, JM Bullion, SD Bullion right now. They're vacuuming whatever inventory remains. Dealers already sold out or charging extreme premiums, and 42,000 contracts worth of buyers are about to hit that market like a tsunami. You need to act immediately, today. Call dealers, buy whatever they have in stock, pay the premium without negotiating, acquire the ounces, because next week there might be nothing available at any price. Here's the final understanding I need you to absorb. This transcends silver. This is about trust. For decades, markets operated on trust. Trust that contracts are backed by real assets. Trust that exchanges can deliver what they promise. Trust that the system operates honestly. That trust is shattering right now. When COMEX declares force majeure and admits they sold contracts they couldn't honor, it transmits a message to every market participant globally. Paper promises are worthless. And if COMEX silver contracts aren't backed by real metal, what else is fabricated? Are gold contracts real? Oil contracts? Agricultural futures? Treasury bonds? How much of the global financial system is just paper claims backed by nothing except institutional confidence and government guarantees? Today's number, 47,012 contracts standing for delivery against 23 million ounces available, isn't just data. It's mathematical proof that the system is broken, undeniable, irrefutable. And once trust breaks, it never returns. Once people realize contracts are counterfeit, they stop believing. They demand physical assets. They pull their wealth out. They protect themselves first. That's what's happening right now. That's what 47,012 contracts represents. Smart money is exiting. They're demanding tangible assets. They're abandoning paper. And when the majority realizes what smart money already knows, the panic will be absolute. This is January 15th, 2026. COMEX published data proving 10-to-1 ratio of claims to metal. Banks are trapped with no escape routes. Arbitrage is dead. Timeline is closing. And you have a choice to make right now in this moment. Are you holding physical metal that exists in the real world, or paper promises that exist only on screens and in databases? Because in 30 days, that difference will determine whether you protected your wealth or watched it evaporate while you were distracted. The mathematics are broken. The system is collapsing. The end game has started. Exit paper. Enter physical. Do it today. This is your warning. This is your window. This is the moment where everything changes. Don't wait for mainstream media permission. Don't wait for official confirmation. Don't wait for the announcement. By then, it's finished. The vault is empty. The contracts are counterfeit. The truth is documented. And the only thing that matters now is what you're physically holding when the music stops playing.